Today, how banks create money. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today, we discuss the latest RBA speech, which contains a perler: banks create money. And by the way, if you value the content we produce, please do consider joining our Patreon program, where you can support our ability to continue to make great content. Here's the link, and it's in the comments below. So there was an interesting speech from RBA Assistant Governor for Financial Markets, Christopher Kent, entitled Money Born of Credit. The first fascinating point was his confirmation that loans create deposits, rather than deposits creating loans, which was the traditional view of how banks worked. This is a crucial pivot because it means banks can create ever more loans provided borrowers are prepared to borrow. Now, this is something I've discussed many times, and I did recently with Steve Keen on the DFA YouTube channel. Here's a link. It has profound implications for monetary policy, not least because control of credit in this model becomes critical. The second point he made is that when he tries to explain why interbank lending rates remain elevated for Australian banks, I think he is less successful here, because the obvious missing link is the risk premium, which is now in place, given the litany of issues raised by the Royal Commission, regulatory pressure, and potential class actions. Our banks are having to pay more for their funding because of their recent track record, and this is not going to flip back anytime soon, in my view. We made a video on this quite recently. But on the creation of money, this is what the RBA said. When customers withdraw currency from an ATM or a bank branch, the value of their deposit holdings declines and the value of their currency holdings increase, but the stock of broad money is unchanged. The vast bulk of broad money consists of bank deposits. These banking liabilities are created when an Australian household or business has funds credited to their deposit account at an Australian bank. And one way this can occur, for example, is when a business deposits currency that it's earned with its bank. Again, such transactions add to deposits but do not create money because the bank customer is simply exchanging one type of money, currency, for another, a deposit. Money can be created, however, and this is the critical point, when financial intermediaries make loans. Accordingly, the concepts of money and credit are closely linked in a modern economy, albeit not one for one. When a bank extends a loan, it makes money available to the borrower, for example, to buy a car, a house, or equipment, or a business. The bank may credit the deposit account of the borrower, who withdraws the funds so to make their purchase. Alternatively, the bank may directly credit the deposit account of the seller on behalf of the borrower. In either case, the loan funds will tend to find their way into a deposit somewhere in the banking system. This process, he says, adds to the supply of money. Now, he said, if I stopped here, you might be left with the impression that the process of lending allows the banking system to create endless quantities of money at no cost. However, the process of money creation is constrained in numerous ways and depends on the behaviour of borrowers, banks, and regulators, as well as the stance of monetary policy. In the first instance, the process of money creation requires a willing borrower. That demand will depend, among other things, on the prevailing interest rates as well as broader economic conditions. Other things equal, lower interest rates or stronger overall economic conditions will tend to support the demand for credit and vice versa. The bank then has to be willing and able to issue the loan. It has to satisfy itself that the borrower can service the loan. The bank must maintain sufficient share of its assets in liquid form to meet any drawdowns relating to the new loan, as well as meeting any withdrawals from existing depositors. Otherwise, the bank runs the risk of failing to meet its obligations when they fall due. The bank's loans and other assets needs to be backed by adequate capital. Capital is needed to absorb unexpected losses arising from defaults or other sources of variation in the value of assets. The interest rate charged on loans must cover expected losses on the loan portfolios, as well as the costs of deposits and other sources of funding. Revenues from loans and other assets will also have to cover the operating costs of the bank, while allowing it to earn a profit so that shareholders can earn a reasonable return on the bank's capital. All of these considerations imply that money creation occurs at some cost, which serves to constrain the extent of lending. These constraints are reinforced by regulatory requirements for liquidity, capital adequacy, and lending standards set by the Australian Prudential Regulatory Authority. Other things equal, anything that reduces the willingness or ability of banks to make loans can be expected to result in lower growth of system-wide money. It's also worth emphasising that the process of money creation is not the result of the action of any single bank, rather the banking system as a whole acts to create money. A single bank may make loans by drawing on its liquid assets, yet not receive the corresponding deposits created in return. Before extending further loans, that bank would need to raise funds in other ways, for example by issuing debt or equity securities, or by waiting for its deposits and liquid assets to rise via other means. Here is an example of an increase in loans of $100 billion. However, the increase in loans in this case leads to an increase in deposits of $60 billion. In other words, the changes are not necessarily one for one. This is because there are other sources of funding besides deposits, and indeed loans are not the only assets held by banks. In the example shown, other funding comes from issuance of debt and equity. The shares from different sources are in line with the actual funding behaviour of the banking system over recent years. In summary, changes in the stock of broad money are the result of a myriad of decisions, including those of banks, their borrowers, creditors, and shareholders. And these decisions take place within the framework of a range of regulatory and institutional arrangements. And it's worth noting that the Reserve Bank does not target a particular level of or growth rate of money, although it has done so under a previous monetary policy regime. Instead, the Reserve Bank has some influence on the money stock by the effect of its interest rate target for the overnight cash rate on other interest rates in the economy. These in turn affect the cost of borrowing and economic conditions more generally. Ultimately, borrowing and lending decisions, and thus the creation of money, are constrained by the need for prudent banking behaviour, the budget constraints of borrowers, and the profitability of lenders. One final word on the creation of money is that, as fun as it may be to teach students about traditional money multipliers, I don't find them to be very helpful to think about the process. In Australia, simple regulatory regimes, which had earlier required banks to hold a minimum share of their deposits as reserves with the Reserve Bank, have been replaced with modern prudential regulation and market disciplines. Again, the demand for and supply of credit is the real driver of money. That point can be reinforced by examining the behaviour of credit and money over time. Given that money is used for transactional purposes and as a source of value, it makes sense that most of the time it would at least keep pace with growth in the value of nominal spending. Indeed, in Australia, it has grown faster than that over the past 40 years, roughly doubling as a share of nominal GDP. Growth of credit has been stronger still, roughly tripling as a share of nominal GDP, from under 50% in the early 1980s to over 150% currently. A closer look at the bank's balance sheets shows how these changes have occurred. In 1980, Australian banks held more than 80% of their liabilities as deposits, worth then around $47 billion at the time. This deposit base was more than sufficient to fund loans of around 60% of assets worth $34 billion. The majority of the remaining assets were held in the form of securities, mostly government bonds. But as banks grew through the next 4 decades or so, there was a marked change in the composition of their balance sheets. These changes reflected choices both by banks and the private sector, and were strongly influenced by the deregulation of the financial system. In particular, constraints on banks' business activities were progressively removed in the 1970s and early 1980s. For example, the interest rate they could charge and pay, their product offerings, lending volumes, and their asset holdings. This was associated with significant changes in banks' abilities to attract and use different funding sources to support balance sheet growth. By the early 1990s, Australia's demand for credit from banks became larger than the sum of all their deposits. And following a period of slower growth, around the early 1980s recession, credit growth picked up again and continued to grow much more quickly than money. To enable this, a greater proportion of bank funding during this period was drawn from sources other than deposits. Much of it owed to an increase in the issuance of debt securities, which was supported in part by a strong appetite from non-residents for Australian bank debt. These trends continued until the global financial crisis. Following the crisis, credit growth fell for a while, reflecting a decline in both the supply and demand for credit. And at the same time, the stock of broad money increased noticeably, rising by around $1.1 trillion, from around 80% of GDP in 2007 to around 115% in 2018. And this strong growth reflected a sharp increase in the share of funding sourced from deposits at the expense of short-term debt securities, consistent with banks seeking more stable funding. Meanwhile, households and businesses increased the share of their assets held in the form of deposits. While loans have grown dramatically in nominal terms, to around $2.6 trillion today, the share of loans on banks' balance sheets is the same as it was in 1980. In contrast, and notwithstanding the increase in deposits since the global financial crisis, the share of deposits has declined over the past 40 years from above 80% to around 50% of banks' balance sheets. Currently, a sizable share of banks' liabilities is in the form of bonds on issue, a source of funding that was less important in 1980. Banks also have a much larger share of other liabilities, such as those to non-residents and related parties, which are not included in domestic monetary aggregates. So looking back, it is clear that there have been many instances of sustained gaps between the growth of deposits and broad money more generally, and the growth of credit. While broad money growth outpaced credit growth for most of the period since the financial crisis, this was not the experience of the 2 decades or more prior to the crisis, when credit typically outpaced broad money. This long history suggests that we should not be concerned about a so-called deposit funding gap. Some commentators have suggested that the recent decline in the growth of the rate of money has left banks with insufficient deposit funding to support credit growth. According to this hypothesis, banks have been forced to seek other forms of funding, including from short-term money markets, which, so the argument goes, can help to explain the notable rise in rates in these markets in recent months. What are we to make of this hypothesis? Well, first, such a gap between the growth of deposits and credit has been commonplace over recent decades, and conditions in short-term money markets were benign through much of these earlier episodes. Second, loans are not the only assets on banks' balance sheets. Indeed, in recent quarters, growth in these other assets has been particularly slow, slower than both credit and deposits. Third, if some banks really did have insufficient deposit funding, we would expect to see them competing more vigorously for deposits by rising interest rates on these products. But retail deposit rates have been flat to down over the past year. In short, there is little evidence that there is any relationship between the slowing of deposit growth and recent funding pressures in short-term money markets. More generally, given my earlier discussion about the extension of credit lending to the creation of banking system deposits, worrying about slower deposit growth impinging on the banking system ability to create credit is putting the cart before the horse. But let me make this point. If the process is that banks create money by lending, and the controls on lending are lax, then the consequences will be an asset bubble and higher risks in the system. And in addition, the way capital adequacy is calculated as a ratio of risk-adjusted assets to bank capital is missing the point. The Basel risk controllers are based on a false premise. Now that's a significant issue which needs to be addressed. Control credit, not so-called financial system risk. So in my mind, the RBA has made at least one step in the right direction, understanding that credit creates deposits. But they have yet to think through the implications of that in the way that risks need to be controlled in the system. And by the way, that's a discussion which I think many central banks around the world have still to address. And by the way, if you value the content we produce, please do consider joining our Patreon program, where you can support our ability to continue to make great content. As always, if you like what you've seen here today, please share and like the post and add a comment or question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting the subscribe bell. And if you have already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst of Digital Finance Analytics. Many thanks for watching, and I'll see you next time.